Investors, are you ready to scale your portfolio beyond the single family arena and even beyond 1 to 4 units, but not quite yet into big commercial? So in today's video, I'm going to break down exactly how to use DSCR loans for that little area in between 1 to 4 units and small commercial or multifamily, and that is 5 to 8 units. Now, this is a growth stage that many investors can legitimately hit, and DSCR financing can help you expand faster, get into this 5 to 8 unit niche, and experience some real cash flow without getting stuck by debt to income issues and the traditional lending roadblocks. But first, my name is Jeremy. I'm a certified mortgage advisor based in Phoenix, Arizona, and I empower realtors, I consult with investors, and we work with homeowners and home buyers on how best to use mortgage financing and creative financing to create wealth long term. So thanks for tuning in, and I hope you enjoy the video. All right, so part one, why 5 to 8 units might be a sweet spot for you. So first of all, 5 to 8 units, obviously bigger than a single family unit and more units than 1 to 4 units. So you can experience some higher cash flow and potentially find some better deals, but yet it's still small enough to be financed really similarly to a 1 to 4 unit DSCR loan. So there's not a whole lot of differences. You can get stronger cash flow per roof, if you will. So oftentimes you'll have maybe an 8-plex with 2 buildings or maybe an 8-unit building all under one roof, which could potentially lower your carrying costs, maintenance and repairs and things like that. So you can attract both, tenants nearby as well as business use operators with 5 to 8 units. There is some mixed use flexibility in some of these lending products. And it's also a great stepping stone to larger multifamily if that's on your radar. Now, the 5 to 8 unit range is something we've underwritten a few deals for in our own portfolio over the years, something that's really attractive to me. And when I see the cash flow figures based on, when you compare them to a normal single family home or even a 2 to 4 unit building, oftentimes the numbers are much better, right? Sometimes these deals are fewer and further between, but knowing how to use financing for 5 to 8 units is going to be critical in your journey, and that's what we're going to help break down for you. All right, now part 2, how does DSCR work when you're looking at 5 to 8 units? Now, this is not that much different from a normal DSCR loan. So you're still going to take the overall rental income generated by the property. You're going to compare that figure with what the market rents are, just like you would for another sort of DSCR loan. Now, obviously, instead of the W-2s and the tax returns and the pay stubs and all that, we're still using the property's ability to generate an income. Nothing changes there. Now, a couple things to note with 5 to 8 units is that lenders, what they're going to look for is they're still going to look for things like your ratio, right? So making sure that you at least are positive in cash flow, that's step number 1 in this process, making sure you have a little bit of cash flow there, and even more attractive terms available if you can hit not just 1.0 on your ratio, which means your rent meets your debt service every month, but beyond that. So if you get up to 1.2 and even 1.25, those are really 2 great stepping stones for the ratio to help increase the cash flow figure, which helps reduce your rate a little bit. And even with a lot of lenders, it'll help increase the leverage in terms of what they're going to lend you for that deal. Now, the LTVs that lenders are going to offer, which is loan to value, so this is how much of the purchase price that they're going to lend based on a percentage, you're still going to be looking at 70 to 80% for the most part on a lot of these transactions if the cash flow is strong. And this depends on the market and it depends on the NOI here. And then additionally, you're going to look at reserves. So reserves are simply how many months of this debt do you have on hand to pay after closing. So a lot of lenders are still looking for 3 to 6 months for reserves for 5 to 8 unit DSCR loans. Lenders are still going to verify leases, and a lot of times with 5 to 8 units, that might take just a little bit longer than a normal single family home with a DSCR loan. They'll verify market rent comparables, and they even can apply a vacancy factor, which is generally not something you see with the lower unit count. So you have to keep that in mind. Part 3, what are some of the benefits to using a DSCR loan for 5 to 8 units versus other forms of financing or even cash? And I think the obvious point here is scalability, right? So if you're able to put 20 or maybe 25% down on some of these 5 to 8 unit deals, that'll leave you with some capital to go ahead and find more 5 to 8 unit deals, or perhaps even 2 to 4 unit deals, or even single families. So the scalability is great. Now the speed going conventional with 5 to 8 units is a little bit more tedious in my experience. So using DSCR calculations where you're really just focused on the underwriting for what the property can bring in rental income will make the process smoother. Now the flexibility is another point. Oftentimes based on the condition of the property and the market data, this will be a strong point when you submit your file to underwriting. And I think the biggest takeaway in terms of the benefits here for 5 to 8 unit deals is going to be the diversification. So there's a lot of value in the investment space for having multiple streams of income or multiple leases that are coming in for one transaction or one deal. So for example, if you have an 8 unit property and you might have 7 units full, you have 1 unit, maybe you need to rehab the unit, or maybe you're just trying to fill it with the next tenant, that's not going to devastate your cash flow and your income. Whereas with maybe 1 or 2 or even 3 units, if there's one of those units that are vacant, especially if it's a single family home and there's only 1 unit and 1 lease, you might be 30 or 60 days waiting on standby for your property manager or for you to go ahead and fill that unit, which means no cash coming in. So that's huge. Now, part 4, there are some challenges that are associated with the DSCR loans for 5 to 8 units. Now, overall, this is something that applies to all DSCR loans, but keep in mind, DSCR interest rates traditionally trend a bit higher than where conventional rates are. Now, it's nothing like it was years ago where you're maybe looking at 1 full interest rate point or even more between what a conventional rate would be and what a DSCR rate would be. They're a lot closer today. And a lot of that has to do with the amount of non-qualified mortgage business or non-QM business that's originated in the US. A lot more investment activity is happening. And lenders, they're gonna wanna make sure they're offering lending products that apply to the people that have the interest. Simple supply and demand. So if a lot of investors are out there looking for lending products like this, you're going to find lenders are going to figure out a way to offer something. And when they first release these products, I find that they're a bit more expensive. They may not be as attractive, but as we see more and more DSCR activity over the last 5 to 7 years, that's now why these rates have come down a little bit and they're a lot more competitive, because a lot of lenders getting involved in the space to offer these products is helping level out the market a bit. Also, they're taking a very close look at default rates and fraud going on with DSCR loans. So you'll see some articles in the news here and there that come up, and they pop up often in some of these markets. I think Baltimore was one recently, and there's been a couple others that have come up where there are large LLCs, large businesses that are defaulting on DSCR loans at a massive rate. So when you get involved with the DSCR loan, do not be surprised if the underwriting may be a little bit more strict than you might be used to, because the lenders are simply trying to do their due diligence. They want to make sure that when they sell these loans, they can sell them off to the secondary market into pools of mortgage-backed securities to investors. Another challenge would be caps, right? There's going to be limits on how many units you can purchase or you can refinance using a DSCR product. Right now, we have several good options for 5 to 8 units, and then we even have some options to go up to 10 and then beyond. And I do feel like over the next year or two, we're gonna find some more lending products that go up to maybe 12 units, maybe 15, 16, and maybe up to 20 units, which is gonna be a huge swing. It's gonna help open up the market a bit more for investors getting involved in that middle ground between 2 to 4 units and maybe 18 to 20 units. There's gonna be some options here as we move forward into 2026, so look out for those options. So part 5, I always find it helpful to talk about a case study. A lot of the consultations that we have, I give them a few examples on how a deal like theirs would work based on some of the files that we've closed before. If you take an example of a 6-unit property, which is one we've underwritten recently, that brings in about $7,200 in rent. Very strong deal. The expenses, we had it calculated. We included taxes, insurance, we included property management, and we also included a vacancy factor. Sometimes it's helpful to throw that in there as a summary to the underwriter, so we're all on the same page and they have an understanding that, yeah, we're calculating for vacancy. We want to make sure we account for that. So that brought the total NOI to about $5,400 per month. Now the lender underwrites the debt service at about $4,200 a month, which creates a DSCR ratio of about 1.28. right? So you have $4,200 in debt service, and then you have about $5,400 in NOI. That's very comfortably above the 1.2 DSCR threshold that we're trying to hit. And in this case, we used a 75% LTV first lien position DSCR loan, which helped the investor leverage into the deal and put a little less capital down than he wanted to initially. So he was able to store some of that capital to show some good reserves, and he's got some capital left over to go out and find the next multi-unit, and hopefully he does. So overall, in closing, if you're looking for more units and you're finding deals, maybe you see them from wholesalers, or you'll see them on lists, or maybe some of the groups that you're in, or even online, there's a lot of great MLS type platforms now that are open to the general public, where you can log in, you can create a profile, you can have access to a large pool of deals that a lot of wholesalers and large scale operations have put together for us, so we can have an outlet to go find some of those deals on market without necessarily trying to track them all down and dealing directly with sellers. And if you have questions or you want some feedback on some of these resources, shoot me a comment or reach out to me, and I can tell you a handful of these places that we go to find deals, and some of these places that our clients go to as well. DSCR loans can be a great option for 5 to 8 units. You can get more doors, you can get more cash flow, and again, a pathway to larger multifamily deals without being blocked by traditional institutional lending hurdles. Now, as always, run your numbers, make sure your numbers are solid, run your own stress tests, make sure you account for vacancy, and definitely shop lenders for the best fit. And if you're serious about scaling long term, this is definitely a great strategy to keep in mind, and I'm always happy to have a conversation about how these 5 to 8 unit DSCR loans work, some of the requirements when it comes to credit. This varies from lender to lender. One of the powers of being in the mortgage broker space is we have a lot of lending options to choose from based on your specific borrower profile, based on your experience, your credit, how much capital you have on hand, what your reserves look like. This is definitely a strategy worth learning inside and out. So hey, thanks so much for tuning into this video. Hope it was helpful. If you find any deals in that 5 to 8 unit range, I'm happy to have a conversation about what that would look like to finance. If you have any other questions about DSCR loans, or if you have any other scenarios you want to review and you just want a second set of eyes, this is what we do. We want you to win. So definitely reach out to us. We're happy to sit down and go over those deals, answer any questions, or run through any scenarios you might be thinking of. And I really appreciate you tuning in. And if this was valuable to you, please click the like button, drop a comment, and I'd love to chat with you more about your questions and your scenarios, and subscribe. Our goal is to bring out as much real estate investment and financing content to you so you have the resources that you need to go out and win in the marketplace. So again, thanks for tuning in. I appreciate you being here, and we'll see you in the next one.